Welcome to Iggy's Insights, where we dive deep into economic topics that matter. I'm your host, Iggy, and today we're exploring a perspective that might challenge your thinking about Thailand's fiscal health. The question on everyone's mind is simple but loaded. Is Thai finance really broke? Before we jump into the current situation, let me take you back to July 1997. Thailand announces it's floating the baht and requests help from the International Monetary Fund. This wasn't just a policy change. This was the moment Thailand's economy collapsed, triggering the Tom Yam Kung crisis. The baht plummeted from 25 to over 50 baht per dollar. Non-performing loans hit 47% of total loans. Financial institutions crumbled like dominoes. The crisis spread across Southeast Asia like wildfire. That was what a truly broke Thailand looked like. Today, we're examining whether Thailand faces anything remotely similar, or if current concerns about fiscal health are overblown. To understand where Thailand stands today, we need to understand the deeper historical patterns that shape how nations manage debt, growth, and fiscal policy. Throughout history, nations have used debt as a tool of economic policy. In ancient Rome, emperors would debase currency to fund military campaigns. Argentina has defaulted 9 times since independence. Greece required multiple bailouts in the 2010s. Each crisis teaches us about the relationship between debt, sovereignty, and economic stability. In the classical sense, a country becomes broke when it defaults on its debt obligations. This triggers what economists call a sovereign default crisis. But default isn't just about numbers on a balance sheet. It's about the fundamental breakdown of the social contract between a government and its creditors. Thailand experienced this firsthand in 1997. The crisis wasn't just about currency speculation. It was the result of deeper structural problems building for years. Thai banks had borrowed heavily from foreign institutions to fuel domestic lending, particularly in real estate. This created a dangerous mismatch between foreign currency debt and domestic income streams. The IMF stepped in with a $17.2 billion rescue package, but it came with strict conditions. Thailand had to close 56 finance companies, restructure its banking sector, and implement austerity measures that deepened the recession. Unemployment soared from 1.5% to over 5%. GDP contracted by 10.5% in 1998. The social cost was enormous. Fast forward to 2025, and Thailand's fiscal picture looks dramatically different. Thailand holds international reserves of 236 billion US dollars. That's enough to cover 8 months of imports and roughly 2.5 times the country's short-term foreign debt. These are the kinds of buffers that prevent cascading failures we saw in 1997. Thailand's public debt currently sits at around 64% of GDP, approaching the 7% ceiling established after the previous crisis. This ceiling was set as institutional memory to prevent future crises. The government's medium-term fiscal plan projects debt will peak at 65.6% in fiscal 2025, then gradually decline to 62.98% by 2029. Revenue collection has exceeded targets. In the first 4 months of fiscal 2025, government revenue surpassed expectations by 10.38 billion baht, driven by a 13% increase in VAT revenue from domestic spending. This indicates underlying economic activity, not stagnation. However, Thailand's debt servicing budget is projected to rise from 9.61% of the annual budget in fiscal 2024 to 15.2% by 2029. Credit rating agencies use a benchmark of 10% for the ratio of interest payments to government revenue. Thailand has crossed this threshold, which could impact its credit rating. Many developed nations operate with much higher debt-to-GDP ratios. Japan runs at over 250% of GDP. The United States exceeds 130%. The difference lies in currency denomination, domestic capital market depth, and economic structure. Thailand's situation is more constrained as an emerging market economy. Thailand faces a concerning structural issue. Household debt has reached 104% of GDP when including informal loans. This creates a debt overhang effect. When households are heavily indebted, they reduce consumption to service existing debt rather than spending. This dampens economic growth and government tax revenues. Historically, high household debt has been a precursor to broader economic problems. We saw this in the United States before 2008, South Korea before 1997, and several European countries before the 2010 debt crisis. The pattern is consistent. Excessive household leverage eventually constrains economic growth. Thailand's economic growth projections put 2025 growth between 2.7% and 2.9%. This growth rate is insufficient to generate tax revenues needed to significantly reduce debt ratios without fiscal consolidation. Thailand's tax-to-GDP ratio sits at around 12-13% of GDP, well below the OECD average of 34%. Despite challenges, Thailand continues attracting significant foreign investment. In 2025, foreign investors made net purchases exceeding 70 billion baht in Thai debt instruments. The Thai baht has strengthened to around 32 baht per US dollar. Foreign funds accounted for over half the bids in recent government bond auctions, which were oversubscribed by more than 2 times. This foreign confidence suggests international investors view Thailand's fiscal position as manageable. They're betting on Thailand's ability to service its debt and maintain economic stability. This external validation provides access to capital markets at reasonable rates. Thailand's fiscal strategy includes significant infrastructure investments. The 2025 budget allocates 9-10 billion baht for capital expenditures, a 26.5% increase. Major projects include the 3-airport high-speed rail link and Laem Chabang Port Phase 3. Historically, infrastructure investment has driven economic transformation. South Korea's rapid development in the 1970s and 1980s was built on massive infrastructure spending. China's growth story similarly relied on infrastructure as a foundation for broader economic development. Thailand's tourism sector is expected to reach 39.5 million visitors in 2025. This recovery provides fiscal breathing room, but highlights Thailand's dependence on external factors. The COVID-19 pandemic showed how quickly tourism revenues can disappear. So, is Thai finance really broke? The answer is definitively no. Thailand maintains strong reserves, market access, and institutional capacity. The country learned important lessons from 1997 and built institutional safeguards. Current fiscal challenges are manageable with appropriate policy responses. But Thailand faces genuine challenges requiring proactive management. The combination of high household debt, moderate growth, and rising debt servicing costs creates vulnerabilities that external shocks could trigger. The real question isn't whether Thailand is broke today, but whether it will implement reforms needed for fiscal sustainability tomorrow. History suggests countries with Thailand's institutional capacity can successfully navigate these challenges. The key is acting before problems become crises. This is Iggy, reminding you that understanding economic history isn't just academic exercise. It's the foundation for making sense of today's complex fiscal realities. Thailand's story shows us that broke is relative, and smart policy choices can prevent fiscal challenges from becoming crises. Until next time, keep thinking critically about the forces shaping our economic world.